So yeah, definitely Ukraine oil price shock played a big role, and maybe also the Federal Reserve raising interest rates to at record pace injected a bunch of money. At this point it's injecting about $1 trillion a year into the U.S.
And then
private
explain
sector.
that again, because I think that needs to be hammered home. Is why, because the orthodox view is that raising interest rates either removes or slows down the creation of money into the system, and you're just saying, wait a minute, high interest rates is injecting money into the system.
Right.
Break
I
that
mean,
down again for the millionth time.
there's no evidence for this supposed causation between interest rates and money supply. In fact, when you run through the numbers and you look at the budgets, you can see that raising interest rates injects more money into the private sector from the public sector. So if interest rates are raised, you have basically the Fed declares a new risk-free rate at which banks can obtain reserves overnight, and it also effectively becomes the rate at which banks, or slightly below that rate, banks lend to other banks overnight if they're short on reserves. So that raises the loan rate that the banks charge to would-be borrowers by approximately that delta that the interest rate is going to. So when we went up from about 0% to 4%, right? Actually, even 5%. That means that basically, by and large, all private sector loans, credit cards, mortgages, etc., went up by about 5% or so. But on the flip side, savings account earnings also go up by about that same amount, which I still hear people talking about. Your savings account only makes you 0.5% or whatever. I don't know what savings accounts they're using or where they're getting scammed, but the
Yeah,
average
there's 4% savings account. I mean, maybe not 4 now that they dropped a little bit, but you can find 3% savings accounts all over the place.
yes, 4 to 5 even. So if you,
Yeah.
but even that's why I always recommend just put it in treasury market mutual uh, a
Nima
treasury.
recommends, but this is not actually financial advice.
Not financial advice.
Nima does it for himself.
Even though this is the safest possible
And,
asset,
and I happen to listen to Nima, but I don't sue him because he doesn't.
not
Whatever.
financial advice. That's just what I do.
Yeah.
So you can put your money in a treasury money market account, and it'll earn about 3.9 to 4% right now. If you put it in a treasury bills directly, auto roll on Fidelity, probably even get about 4.25 to 4.5%, 4.25%, I want to say. But you don't have the liquidity of the money market fund, obviously. But so my point just being that the earnings on the savings accounts match the increased earnings on savings accounts in the private sector matches pretty much to a dollar the delta in interest payments that the private sector has to make now. I know a lot of people aren't savers, I guess, so it doesn't feel like that to them. But in aggregate, for every loan, there's a deposit. So for every interest payments that are increased, the corresponding savings accounts that the money ends up in, unless some of it isn't obviously in checking accounts, okay, but that's only for transactional stuff. Majority of it sits in savings accounts, treasury, money market, mutual. They will earn about the same amount of interest as the loan rate has increased. So that is a wash to the private sector. There's an increase in interest payments, but there's an increase in savings interest earnings as well. That's a wash. However, all the money, all the treasury bills and bonds interest are net injections into the private sector on top of what I was just explaining. So you have the two savings and lending rates, deltas matching one another. On top of that, you have treasury bond and treasury bill interest earned by the private sector. That is all free and clear extra earnings to the private sector. And like I said earlier, I think the U.S. government pays something like $800 billion to $1 trillion per year in interest to the private sector.
And to be clear, sorry to interrupt you, but that's an injection from nowhere. right? There's this idea, and we're going to be going over these orthodox views. There's this idea that, oh, we got to go tax the money to generate it or borrow it so we could pay this stuff now. That's totally false. That's not what's happening. At the Federal Reserve, when the bond matures or they have to pay out the rate, they just type a number into a computer, bloop, and the number appears. So when Neiman says it's a net injection, okay, so there's $1 trillion of bonds that mature every year. Now
Way
that the
more, way more.
I'm sorry, the net injection. Excuse me.
Yeah, the interest payments per year.
As the interest payments have increased, it's not like that money has to come from somewhere. It's just typed into the computer. So when the interest rate goes up, it's literally injecting money in from nowhere. But as Nima likes to point out, only with people who already have money.
But also, it doesn't. It's not earned by people who do work, right? It's earned for doing nothing. It's a basic income for the rich. So that is on its face, I would argue, inflationary. Now, some people may say, well, but these people don't spend the money, they just keep accumulating. But some of it may trickle out. Like I said, it's not a hard and fast rule, right? One way or the other. I'm just saying that the numbers wise, there's a stronger case to be made that high interest rates are inflationary. Also, you can look at countries like Turkey and Argentina until not too long ago.
5 minutes ago, yeah.
Yeah, they had very high interest rates and very high inflation. Professor Werner has pointed out that the only empirical conclusion we can arrive at is that that the central banks of the world adjust their interest rate based on the current inflation level. So they follow the inflation rather
as opposed to causing it.
As opposed to causing it, which I am guessing, kind of the semi-tinfoil hat in me is guessing that maybe that's just what they want. Maybe they just want to preserve the money owner's wealth by paying them some sort of corresponding interest rate that makes up for the inflation that they've measured.
I don't even think you need a tinfoil hat. I would say that's an obvious pressure, right? Whether or not they're succumbing to the pressure, or that's the main pressure, or the secondary pressure, or whatever. I would say that that's definitely a pressure of, hey, I'm billionaire, whoever, and if you increase the rates by 3%, I get however much money more a year for nothing, right? So I would
absolutely.
I don't think that's even semi-tinfoil. Maybe it's tinfoil to say that that's the actual reason, but I would say it's absolutely pressure.
No, I don't know, because these people at the top, they kind of don't really know what they're doing. It's usually the people who are behind the buttons and faceless and nameless who know what's going on. But the political decision makers, as we have heard from many people like Warren Mosler and others, and Richard Werner, they don't really know how this works, or they just don't want to bother with trying to explain it to people who have been propagandized with a bunch of neoclassical bullshit, right, and are just going to, not going to vote for them.
I want to address one more thing about, whether the interest rates create more money or not through the private banking system, because I have heard this argument as well, which is, and it sounds like a reasonable argument, is that, well, if you increase the interest rates, you're making money more expensive to go out and get a loan, right? Whether you're buying a house, buying a car, you're financing a business, whatever. So the amount of loans, which we know are creating money out of nothing, decrease because the money is more expensive.
Well, do they, though, is the question.
Yeah, well, that's what I'm saying. It's a reasonable argument, but when you look at the evidence, they don't. Right? So Mike Norman, who's as far as we know, the only MMTer who's giving trade advice online, he just, every day, every week, however often he does it, there's Federal Reserve reports that tell you, here's how many loans were created today, and he can look at the year before and go, okay, well, it's up, it's down, it's left, it's right from the year before, and we're paying attention to Mike Norman, and almost every time it's like, loans are up, loans are up, loans are up. Yeah, even through the whole COVID interest rate increase fiasco, people are taking more loans, even though the interest rates go up. So, I don't know exactly why the reason is that might be the case, but the
Well,
reason
because
Canada doesn't matter because we can just look at the evidence.
yeah,
Yeah.
it's plausible that the reason is just that the economy, the corporate sector has been very profitable because of all the deficit injections. But these deficits end up in the form of corporate profits at the end of the day. And when corporations have good profits, then people want to lend to them. And it's easier for them to obtain loans when they have when their asset base, that their profit generation is backing that up.
Well,
Um,
I mean, not wanting to dox myself here, but I mean, I'm done a business acquisition before. I'm looking into another one right now, and for the first one, I did get a variable rate SBA loan, and I didn't get it like at the bottom of COVID. I got it like when the interest rates were like halfway up, and then they went up the other half after I bought the place, and it was annoying. I mean, my added another $1,500 a month of interest or whatever to the payment I had. But in terms, it didn't wreck the business, right? It was, I mean, like you said, all the prices went up from at the same time. So I mean, obviously, I'd rather have a low interest rate than a high one. I don't want to pay any interest, but at the same time, it got the deal done, and we're making money. And on the next acquisition, I mean, it's not like, oh, we can't, interest rates are too high, we can't do it. It's just, okay, well, how does the math work out, and how do we adjust the offer based on the math? If everybody who's watching this now or recording could like, share, and subscribe it helps us out a lot.
yeah.
I hate saying it, but it's just true.